Hey guys, what's up? I'm Erin and welcome back to the channel. Chances are, if you're in the market to buy a home, current mortgage rates have caught your eye. Mortgage rates continue to make headlines as they hover near the highest rates we've seen in the past 20 years or so. Late in 2023, mortgage rates peaked near 8%, but have since come down closer to the 6.5% range when you're looking at a 30-year fixed-rate mortgage. Now, rates like this are not unheard of. If you go back to the early 2000s, these rates were the norm. If you go back further into the 80s or the 90s, the rates were even higher than this. But if you're strictly looking at recent history, the past 10 or 15 years, these rates look incredibly high. During this time frame, rates easily hovered near 3 or 4%, and during COVID, they actually got pushed lower near 2% or so, and a lot of home buyers took advantage of these great rates. 62% of current mortgage holders have a mortgage rate that is less than 4%. And the rate that you can capture on a mortgage has a big impact on the home you can actually afford. And with home prices near the highest level they've been ever, and mortgage rates near the highest they've been in over a decade, this can cause home buyers a lot of stress. This can make housing seem relatively unaffordable. Let's run an example. If you were to get a $350,000 mortgage at today's rate, simply considering the monthly mortgage payment, principal and interest, the monthly payment would be around $2,300 a month. And over the course of a 30-year mortgage, you would pay a total of nearly $470,000 in interest, meaning that this home with this mortgage would cost over $800,000. On the other hand, if we were to look at a $350,000 mortgage at a 3% rate, again looking simply at principal and interest, the monthly payment would be about $1,500 a month, and over the course of those 30 years, you would pay roughly $180,000 in interest, meaning that this home would cost you a total of about $530,000. It's easy to see how different interest rates have a really big impact on the overall price of the home. If you can capture a lower interest rate, your monthly payment is lower. This gives you more breathing room within your budget, so it gives you more money to work with on a monthly basis. And in the long run, it saves you hundreds of thousands of dollars in total interest costs. But there still could be a way to snag a 3% mortgage rate. Is there a catch? Absolutely. The property you're looking at must qualify for an assumable mortgage. So what is an assumable mortgage? It's a type of home financing arrangement where an outstanding mortgage and its terms are transferred from the current owner to the buyer. By assuming the previous owner's remaining debt, the buyer can avoid obtaining their own mortgage. So if you assume a mortgage, you take on the current principal balance, the current interest rate, the repayment, and any other contractual obligations with that loan. So for instance, let's say we had a buyer who took out a $350,000 mortgage on their home when they purchased it. Let's say they purchased this home 5 years ago. Terms of the loan, $350,000. It was a 30-year term and a 3% interest rate. Over the course of the past 5 years, let's say they've paid down the principal to $320,000. If you were to assume this mortgage, it would have 25 years left as a repayment schedule. So you would take on the outstanding balance, the $320,000 at a 3% interest rate to be paid over the next 25 years. So if you were to take advantage of a situation like this would allow you to lock in a mortgage for a shorter term length and at a much lower rate than today's current market rates. Now, if you're thinking, I haven't heard of an assumable mortgage before, you're not alone. They're not really talked about that often because the most common loan types, conventional loans, are generally not assumable. For a loan to be assumable, certain criteria has to be met. Popular loan types that are assumable are FHA loans, VA loans, and USDA loans. There are specific criteria for FHA loans for them to be assumable. There's an application process to prove creditworthiness, and the home must be used as your primary residence. VA loans are offered to veterans and/or their spouses. But the good news is that if you attempt to assume a VA loan, you don't have to be a veteran. USDA loans are offered on rural properties. They often come with very favorable interest rates and require no down payment whatsoever. But again, there is an application process that has to be completed if this is to be approved as an assumable loan. The vast majority of properties today listed on the market are not listed as being sold with an assumable mortgage. In fact, roughly 0.5% of all properties listed are listed as having an assumable mortgage. Certainly, many more properties might be eligible for an assumable loan from the current owner to buyer. So it's worth asking if the current buyer has a loan that they would be willing to transfer. What you would be looking for is, does this property have a government-backed mortgage? Once you dig into the data a bit, you'll find that 1 out of every 5 homes with a current mortgage have a government-backed mortgage. So there is the potential that assumable mortgages might become more popular, but keep in mind that current home inventory levels on the market are still actually quite low, so it can make these deals harder to find. But if a seller is willing to consider an assumable mortgage, that can make a home more attractive to potential buyers. The biggest advantage of an assumable mortgage in our present environment is that you might be able to nab a mortgage at substantially below current market rates. Current mortgage rates in today's environment are hovering around 6 or 7%. But if you can assume a mortgage that was initially started during the low interest rate environment, you might be able to obtain a mortgage that was started with a rate of 2% or 3%. And over the course of the life of the loan, this can save you hundreds of thousands of dollars. It can also be beneficial in that the application process is a bit more streamlined and that the buyer would not need to apply for a new loan. This can result in significant cost savings. Yes, there are still transaction costs associated with assuming an existing loan, but those transaction costs are significantly lower than traditional closing costs. Being that only government-backed mortgages are eligible to be assumed by buyers, this would limit housing options if this was a route you wanted to go. And being that we're in an environment where there's already less inventory on the market than usual, this could impose more restrictions and more limits than the traditional buyer might be really willing to consider. An assumable mortgage may require a hefty down payment. This all really depends on how much equity the homeowner has already built up in the home, or how much the home has appreciated since the homeowner bought it. If the homeowner has relatively little equity in the home, the buyer may be able to get away with a lower down payment. On the other hand, let's say we have a home that was purchased in 2020, valued at $400,000 at the time, with an initial mortgage of $350,000. Let's say today the present mortgage outstanding is $320,000. If today that home is valued at $450,000, this buyer would need to come up with a down payment of $130,000 to cover the seller's equity and then assume the remaining $320,000 mortgage. Now, there can be a workaround to the hefty down payment that would otherwise be required, and that could be to take out an additional mortgage to cover the difference. In our previous example, maybe our home buyer had a $30,000 down payment and applied for a $100,000 mortgage at today's current rates and assumed the outstanding $320,000 mortgage. Yes, this situation does get a bit messier, but it still has the ability to save you significantly over time in the form of lower monthly payments as well as significant interest savings over the course of the life of the loan. And you do always have the option of trying to aggressively pay down that loan that you got at today's interest rates for further interest savings. It is worth keeping in mind if you require a second mortgage, a mortgage to kind of bridge that gap in the down payment, lenders may not like this, and at that point they may say that this loan is no longer assumable. So it's worth asking. Some lenders will say yes, others will say no. And it is worth noting that if there are 2 mortgages out on the property, that does inherently make it a little bit riskier, so banks can be sticklers when it comes to this point. While assumable mortgages certainly are more the exception rather than the rule, there are opportunities out there if it's something you're willing to look into. We can expect that higher mortgage rates are going to hang around for a while. And if an assumable mortgage is not in your future, an option that's not available to you, there are other things you can do to save money when it comes to housing. If you're looking to take out a mortgage, you could take out one that has a shorter term length. You're likely to find more favorable interest rates on a 15-year term loan rather than, say, a 30-year term loan. Or you can save up for a bigger down payment. All of these options would save you money in the long term. One of the best things you can do when it comes to housing costs is to buy a home that is well within your budget. Would you ever consider an assumable mortgage? Leave your thoughts in a comment down below. I post new videos every single week. If you got anything out of this one, please give it a like. If you're new here, please consider subscribing, or if you know of someone who might get something out of this type of content, please consider sharing. I'll see you soon. Bye.